Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand the level of risk in the stock market through our proprietary market risk signals that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Monday, March 27th, 2020. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. Today we were up 1.47% on the S&P 500 and closed at 2878.48. What we're looking at here is a year-to-date chart of the S&P 500. Each candlestick represents 1 day of trading. What we can see here is that today was the first day, and it'll be a little bit easier to see on one of the other charts, but today was the first day really since March 6th where we had the entire day's trading above 2850. And it was only the second close we've had above 2850 since March 23rd, which so far in this downturn has been our lows. I know a lot of people have a lot of opinions about this, but look, none of us know for sure that that's going to be the ultimate low of this downturn, okay? But so far, since March 23rd, this is only the second time we've closed above 2850 and only the third time we've closed above 2850 since March 9th. That's this negative day here. So March 10th we closed above 2850, and then on the 17th of April, and then, of course, today, the 27th of April. So, the question will become, can we continue to close above 2850? That, of course, nobody knows for sure. And also, has this market shifted into another gear where we know that all of us know, right, that earnings are going to be off at least 20 to 30% in calendar year 2020 versus 2019, and earnings are likely to be lower on the S&P 500, on the Dow, on the major stocks that make up the bulk of the indices in the U.S. Earnings are likely to be lower than they have been for the last few years. So, are we as market participants willing to pay more for $1 of earnings than we have for many years? And that really will be the question going forward, because that's the only way these markets are going to continue to go higher. Okay, so just kind of keep that in the back of your mind here. And now let's take a look at the intraday chart. So this is a 1 day chart of the S&P 500. Each candlestick represents 1 day of trading. We can see here we had a pretty bullish day, just kept going up and up through most of the day and kind of sold off the last 15 minutes. And again, we closed just beneath that 2880 level at 2878.48. And when we go back and look here on March 10th, on that day, we closed at 2882.23, so just a hair higher than where we were today. And on the 17th of April, we closed at 2874.56, so just a couple of points below where we closed today. Now let's take a look at a 1 hour chart of the S&P 500 going back over the last couple of months. So this is a 2-month 1 hour chart. Each candlestick again represents 1 hour of trading. And I just thought this was kind of interesting. This blue line is set at 2882, which is where we closed on March 10th. And you can see here that even on these 1 hour charts, we just have not been able to close above this 2882 level, including today, right? We closed just barely beneath it, but this 2882 level on the 1 hour charts are really acting as overhead resistance. So it'll be interesting on the 1 hour charts to see over the next few days, over this week, can we start to close above that level? So that'll be another interesting thing to watch on that time frame. Now, when we pull back and look at the weekly charts, this is a 3.5-year chart of the S&P 500. Each candlestick represents 1 week of trading. We know that above this 2850 level, we keep running into overhead resistance, and we have had a problem closing above 2850 really since the first part of 2018. We can see here that we got above it for 1 week and then got rejected. We got above it for a few weeks, got rejected. Each time we pulled back to, at least the 2750 level, right? Even in 2019, we get above this level, pull back. We get above it, and we had a small close below 2850. And finally, we started to consistently close above 2850 at the end of the summer of 2019. And so the question again is, with earnings likely to be lower than they have been for the last few years on the S&P 500, maybe substantially so, you know, are we as market participants willing to pay more and more for a dollar of earnings over the next couple of years, which would continue to drive this market higher? Keeping in mind that the only two things that matter are earnings and the multiple you put on those earnings. That's what causes a stock or a stock market to go up. It's the earnings times the multiple. So, you know, if earnings are going backwards, and they are this year, right? Earnings are going to be less than what they were last year and probably less than they've been for the last few years. If earnings are going down, then the only way the stock market can continue to go up is if we as market participants are willing to pay more and more for a dollar of earnings. So that will be the key question going forward is, you know, can we continue to close above this 2850 level? And keep in mind, the further north we go above 2850, right, the further up we go, the more overhead resistance we're going to run into, and also the more stretched this rubber band is going to be. So I would be careful here, guys. I wouldn't assume that this 2850 is going to hold. If you are long this market, I would put in some short-term stops here, probably somewhere, you know, 2800 to 2850. That's obviously up to you, but just understand that we've had a heck of a time trying to get above and stay above this 2850 level. And, you know, we really need these markets to prove themselves because there's still a lot of challenges out there. Another thing, guys, just because the market has been going up, don't assume that that means there's less risk in the market. If anything, the faster we continue to rise, the more risk there is of a reversal of some sort. So we know the short-term line in the sand is now 2850, but the major support levels that we need to keep in mind are 2750, 2630, and then, of course, 2350. So keep those in the back of your mind if this market does roll over. But for now, we've got a close, an entire day where we traded above 2850. And again, you can kind of see that here. You know, 2853 on today's session was really the lows that we put in. So, you know, we had one entire day now that we've traded above 2850. And again, that's the first time we've done that since really March 6th. So, you know, from a technical standpoint, that is positive. But this market, to me, is still very scary. There's still a lot of unknowns, so don't get too comfortable and too confident. Keep your stops tight. Don't be afraid to take profits if the market starts to roll over here. And remember to subscribe to this channel. Please give me a thumbs up on this video and check out some of my other videos. I've got a lot of great videos, not only just the daily videos that I do like this, but there's a lot of other evergreen type educational videos out on my channel, so please go out and check those out. Also, if you are a financial advisor or an individual investor that manages any of your own money, including in your 401k, your 403b, your IRAs, or of course your trading account, I would encourage you to take a serious look at Simple Market Signals, which is my personal risk management model that I have now made available to the public. For those of you who would like to learn more about how Simple Market Signals can help you in both up and down markets, here is some additional information.